Welcome back to the course Introduction to Commercial Banking, and in the last session we were discussing the early warning indicators, and we saw that there are different types of indicators that we measure, but we were focusing on the market based early warning indicators, and we focused that if the stock price of a particular bank is falling, it means that it also triggers a shock, and that shock has impact on the investor confidence, and also it talks about certain issues with the balance sheet of the bank, which could be linked to the profitability, and that may further worsen the insolvency risk. Then here we have the bond yields and credit spreads, that we often say that if we are seeing the credit risk, then if you are having the higher interest rate, as I mentioned, the bond price declines. As a result, your yield increases, but yield often includes that you have the higher credit risk, and it also demands the compensation from the investor. Then here we have the market based another measure, which is the credit default swap, which basically mentions that how we can have the swapping of a debt with some other instrument, and this is where it also mentions about the overall. So it gets traded in the market. If the price is higher, it means that it shows that the quality of the I would say credit is good, but if it's lower, then it indicates that it is not good, and that has a lot of implications on the spreads that we see with the banking sector. There are other indicators like mortgage backed securities and others, but those indicators also play important role. In this particular slide, this particular indicator is important because it mentions the general understanding about based on adaptive and rational expectations. So for example, if market prices incorporate forward looking expectations about bank solvency, and for example, if the bank's stock price falls from 500 to 200, then we know that it has declined by 60%, and this will bring a lot of negative impact on the investors' confidence, and this will have impact further on the overall functioning. And if there is no improvement, and if there is no signal of improvement, then this may create a bank run kind of situation. So this is what so it gives the forward looking signal. This is what we are mentioning, and it also shows that whether bank is under distress or not. So this is what it implies. In India, we saw that the Yes Bank problem that started in 2018 after the NBFC episode, and it continued till 2020. It has the significant deterioration since it was exposed to one particular entity, and this is what the overall scenario looked like. And it was also linked to NPAs, and they were also, so all the investors also got the idea that the bank has the deep trouble, and as a result it was shown with the stock price fall that further exacerbated the problem, and a whole lot of issues came up, and as a result Yes Bank was to go for insolvency. This is what it comes out. So overall what comes out that the stock prices are the better early warning signal. Then here we have another important, when early warning signals emerge, regulators intervene. So what will be the regulatory stand on the early warning signal indicator? So it could be in the form of capital infusion. The central bank may say that there will not be any dividend announcement. So this is what we are looking. It can also restrict for both good borrower and the bad borrower, both. It can restrict the credit expansion, so it will not allow. It can also increase supervision, so this is what it implies, and it can also go for management replacement. So this is also is the case. So prompt corrective action is the case here. So PCA in India, it was introduced after NPA crisis, and central bank took measures. So it could be for these negative profitability, high NPAs, and low capital ratio. So these are the three indicators. Let's have the discussion in detail about the prompt corrective action. We call it as PCA. So PCA is a supervisory framework used by the Reserve Bank of India to identify weak banks before insolvency risk becomes severe. So before going for insolvency, central bank identifies that. So what are the core objectives? So here is it prevents the bank failure through early intervention, protect depositors and the financial stability. So this is also one important part, and it also restore bank capital, profitability and asset quality. So what is the logic? That the central bank will intervene early and it will reduce the probability of the bank failure. So this is what the overall picture looks like. So as it is a supervisory framework, so it will be based on certain indicators. Central bank will target those indicators. So what are those indicators? So these are indicators or variables that we have to always see. So what is that? It is a capital adequacy ratio, whether the bank is able to meet the capital adequacy ratio or not. In case of India, it was 9%. Then here the net non-performing asset, this indicator will be checked. Return on asset on profitability side, and leverage ratio, that how much the bank has the leverage, right? So this becomes an important indicator. If it goes below or above the threshold, then the central bank will trigger the shock and then they will try to take action on the bank. Otherwise, and if there is also a negative profitability, means bank is incurring losses, then that also becomes the important topic to be taken care. And this is where the PC analysis becomes important, and it is also linked to the. So for example, a bank reports a capital of rupees 800 crore, a risk weighted asset is 10,000 crore. So you can see that the minimum requirement is 9%, bank is having only 8%, and which means that it requires the PCA intervention, which means that one indicator failed. So then the bank will evaluate all other indicators, and especially with NNPA they will be very particular, and so it signals that insufficient capital to absorb potential losses, and this creates further trouble for the PCA trigger. Now it also based on the asset quality. So suppose bank loan portfolio has 20,000 crore, the non-performing asset is 30,000 crore, so your NNPA ratio is 15%. So high NNPA indicates that the asset quality is really high, and this creates the trouble, right? So how much is the non-performing asset to the total loan portfolio that we have? So this is what we get. If it is 15%, it means that 15% out of 100 rupees that the bank is lending, 15 rupees is going for NPA, and this is a big amount. So this may trigger the PCA kind of restriction from the central bank, and this is where the supervisory action will be taken by the central bank on the bank. So typically, as I mentioned, that it will be through the restrictions imposed by the bank, by the central bank on the particular bank which is facing the PCA trigger, and as a result the bank, central bank, if it is a government owned bank, then the central bank will also try to infuse capital to reduce the risk, and at least it will make sure that the bank is able to maintain the required amount of capital. So this is where it is important. So PCA basically prevents further deterioration of the weak bank. So this is where it is important, that how it has to be triggered. So I hope this simple understanding will help you shape your understanding about why systemic risk is a multidimensional topic. It is not just related with measuring the risk, it is also talking about the early warning signal, market based, then there are structural, there are other kind of triggers, for example prompt I would say corrective action that we see. So this is also one of the important variables to look at. So this is what it implies here. So in during NPA crisis, which we often say the twin balance sheet crisis, it started in 2016 beginning, and then it went till 2018, but the signs were seen in 2015 only. So several PSUs banks were placed under PCA by RBI. So for example, India Overseas Bank, Bank of India and UCO Bank were merged, and after that some of the banks were also merged. So banking merger that we saw in India, it was also partly because of the high NPAs reported by the banks. So government recapitalization, capital ratios, asset quality, after this exercise we saw that the banking sector had the better outlook, and it went for the asset quality improvement, and also the bank exited the PCA after understanding this. So this also created the overall understanding about. Now if I have to summarize what we have covered so far. So in the beginning we covered the macro potential risk, we also covered the macro potential risk, we covered the stress testing, which is also one of the important topics to be discussed. Then here we discussed the early warning indicators. Then we also saw that due to stock price fall, the market monitoring becomes important topic, so we also touched upon that. Then we also touched upon the supervisory inspections, that how supervisory role plays important role and how we can prevent the banking crisis. So with this, I hope for all of you it is important that you are able to understand the risk. Now if I have to come back to the systemic risk topic again, because now we will be getting into some of the structural based indicators, and those structural based indicators are worth understanding. Some of you may find it slightly advanced, but I will request you to please have patience, and maybe once you know about these indicators, then you can explore further through different documents available online or through textbooks, but it is important that we must learn about this. So systemic risk, basically it is the contagion across institutions, amplification mechanism, spill over to the real economy. If the banks are in trouble, then overall borrowing and lending will be restricted, and this will have further negative impact on the multiplier. So overall money multiplier dynamics will change, and this will have the non-linear effect, and this may be difficult to measure. So excess leverage, maturity mismatch that we saw. So these are the simple exercise. In amplification mechanism, so we can go back to the Diamond-Debig model that we have discussed, that in the Diamond-Debig model we saw that those people who are reaching late to the bank, they are getting not the full amount that they deposited with the bank, they are getting less than that, because bank is able to sell the asset at the fire sales, which means that it is selling the asset at discount. So if the bank is selling the asset at discount, then it means that bank will be paying also the less. So this is what, so fire sales reduce asset prices, margin calls increase deleveraging, so this is also one important. Funding withdrawal causes liquidity crisis, people are lining up and trying to risk weights rise in the downturn. So maybe you are moving towards more of the risky side. So if you have more exposure to the real estate, different corporate loaning, then those will further leads to the increase in magnitude of the risk. So this is also one of the important factors. Let's get into some of the concepts related to what we call it as the structural based measures, and the very first measure is called distance to default. How much a bank is maintaining a distance from default. If it is further away from default frontier, then it means that it is doing better. If it is near to that, it means that it is going to default. But there are different, it is not so easy and a straightforward topic. So what it measures, it is a structural measure of insolvency risk derived from the Morton model of firm capital structure. So default occurs when the market value of the asset, this is the key, falls below the value of the debt obligation. So if my market value, which means that I will be driving from the stock price, maybe the market cap, or maybe I will be taking some of the derivative values, and then I will be trying to get. So default condition is the value of asset is less than the value of debt obligations, then it creates the trouble, and this is linked with the structural, because the asset size is falling, and then we are seeing that the debt size is increasing. So this is where, so DD measures how many standard deviations the asset value is above the default threshold. So the formula for this is log VA upon D plus R minus 1 by 2 sigma square A multiplied by T upon sigma A root T. And if I try to explain what are these, so I have given the detailed description because these are important indicators. I will come back to previous slide again. So here it is the asset value that here we have. So in this case that we see, so this is the asset value that we are getting. Then the amount of debt, how much is the debt that the bank is having. Then asset volatility, right? It means that if it is talking about whether this asset volatility leads to insolvency risk, so this we often mention, and the time horizon, that how much period, so maybe 1 year, less than 1 year, what is the situation that here we get in. So this is what we find, and the rest of the indicators are derived. So this you have to calculate, this you will have to calculate. But if you search on internet, there is a very good Excel sheet already calculating the DD for the bank. So this is what, so higher DD value that we are getting, it leads to lower probability of default, lower value of DD because it involves also the distribution, so cumulative distribution will be applying. So lower DD, it will lead to higher insolvency risk, and this is what here. So lower DD is avoided, higher DD is applicable. So here we can see that suppose a bank has the asset value of 500 crore, the debt obligation for this bank is rupees 450 crore, right? The asset volatility is 20%, the time horizon is 1 year, and assuming that the risk free rate impact is very small. So we can easily see that here we are just putting that into the formula and we are getting the value of 0.525. How it can be interpreted? So it can be interpreted that the bank is only 0.53 standard deviation away from default, and which means that the higher value it creates. So we saw here, right? So we saw here that higher DD, lower probability default, lower DD, higher probability default. So now here we can see that it is nearby the default frontier. It means that this bank will experience a higher the probability of default. So let's have the example. For example, suppose the bank increases capital and raising the asset value of rupees 600 crore. So the new value is 600 crore, the debt is 450 crore, the volatility is 20%. So here DD would be 1.44, but 1.44 is above than the default frontier. So how do I calculate the 1.44? What is the probability that we are calculating? So if the DD value for 1 year horizon, so here we will be taking into the cumulative distribution function, and since it is below, so negative value will be considered. So it is probability of default that will be calculating will be phi, the value is minus 0.65. So the value comes out to be from the table, it comes out to be around 25%. For DD 1.44, as you can see, the higher value implies around 7.5% of probability default, which means that higher DD, low probability default, lower DD, higher probability default. So this is what it is. Default occurs when the asset value falls below the debt. So this is the reason that we are including a negative. But in real life, it is not so easy because value of the asset becomes important, and sometimes we calculate through market cap, price of the asset. Sometimes we get through the Merton model, which is very much popular with the structuralist idea. So this is what we get. So I hope this understanding has helped you. And for some of you, those who are interested in learning further, you can get back to some of the concepts related to DD and how it is calculated, right? Apart from this, another important concept is so here we can see that if I have to consider, so prior to regulatory intervention, so if I have to connect with the Indian banking system, so falling equity prices leads to lower asset value, rising market volatility, sigma, it leads to higher asset volatility, and as a result, and rising debt related to asset value, it also comes down. It means that distance to default is coming down and default risk is also increasing. So which also means that for example, Yes Bank, we saw that the market capitalization declined sharply. Credit also worsened because of the negative perception, and it also created the financial instability kind of situation. So another important concept which is linked with the structuralist idea is the distance to capital. So distance to default, we saw that if you are nearby, then it means that you have higher chances of default. If you are further away, higher value implies low probability default. So that we were able to see based on the concept of distance to capital. So we were able to see with the higher DD, we were able to get the lower probability of default, and as a result, we saw that the lower probability default value is avoided. Here we are going to get into distance to capital. So what is the distance to capital? So how much you have the actual capital minus the required amount of capital that you need upon the risk weighted asset. So it measures basically, so DCC measures distance to regulatory breach, capital it measures, and DD measures the distance to how much you have the default that you can see, right? So this is what. So Suppose an Indian bank reports total capital of 900 crore and required regulatory capital of 800 crore. Risk weighted assets are 8,000 crore. So distance to capital is how much? 1.25%. So this is what we employ, right? So 900 minus 800 upon 8,000. So it is coming out to be 1.25%, which means that a bank can absorb losses equal to 1.25% of the risk weighted asset, and this implies that it doesn't need so based on the, so let's have the understanding once again. So total capital is 900 crore, required regulatory capital require is 800 crore, your risk weight is 8,000 crore. So which means that you are above just 1%, 1.25% of the minimum capital requirement, and this is like you are almost close to the risk side. So your distance to capital is supposed to be higher, so that you will have the more, I would say, cushioning for getting into trouble. So a small DC implies limited regulatory capital buffer. So you have only 1.25%, because you have only 100 crore above, right? You have 800 crore required, you are having 900 crore. So 100 crore rupees, it's just like 1.25 by getting, and this is what you have. So distance to capital value supposed to be higher, and this is where it plays very important role. If we are going to get into the stress scenario capital, that how we are going to see. So here we have, suppose credit losses reduce capital by 150 crore. So now out of 900 you are 750. Now you can see that you are into negative now, and this is where the trouble comes. Now distance to capital is negative. Negative indicates that you are breaching the regulatory capital, and this will create further shock. So it may lead the central bank to apply PCA on you, or it will go for recapitalization. Or so this is what prompt corrective action be required, and it also requires the recapitalization. So I hope these two examples have helped you understand the idea. So if I have to compare between distance to capital and distance to default, so concepts are both like it is regulatory breach is talking about. Distance to default is about the insolvency, bankruptcy kind of scenario. Here you have accounting, and but here we use the market base. So when I was calculating, we have paper on this. If you can search in the Journal of Financial Research later, so we have used this particular indicator. Here distance to capital is regulatory measure, because whether you are maintaining the required amount of capital or not. So this is actual capital minus the minimum required capital upon the total risk weighted asset. So this is what, this is market based structural measures, and this is more important. It has the limited role because you have the CAR already, so you can easily mention. But distance to default is more popular across the academia and everywhere, and a lot of people use this particular setup. So I hope this understanding will help you. Another important indicator is the distance to insolvency, which is the Z-score measure, and that can be converted further with the distributional value. But here you can measure through higher Z, it means that you have the lower probability. So ROA plus equity upon assets upon the sigma ROA. So Z-score is considered as, if it is higher, it means that you have the lower probability of insolvency. If it is lower, then you have the higher probability. And in the same way, distance to capital, we can also think about converting this into the certain probability value. But if you are getting, for example, if the ROA is 1%, the equity to assets are 8%, and sigma ROA is 2%, then Z value is coming out to be 4.5%, which means that you are just 4.5 standard deviations away from insolvency, and this is what the distance to insolvency shows, and it is also one of the important indicators we often use. Then we have already discussed leverage, which was CET upon the total exposure, but here we are going for accounting based measures. So leverage measures the extent to which bank finances assets using debt rather than equity. So total assets upon equity capital is called the leverage. Higher leverage implies that you have the greater reliance, which may, because the numerator is higher, it means that you are doing better, and which means that higher leverage implies the greater reliance on the borrowed fund, because total asset is the loaning is the asset for the bank. Higher leverage increases also the vulnerability, because if the asset is impaired, then a lot of your capital will be eaten, and this is where the issue is. Highly leveraged banks face higher insolvency risk. So this is what here. So the asset is 10,000 crore and suppose equity is 400, then you are almost 25 times higher than the leverage value, and this is where it shows that you require equity supports assets 25 times larger than the capital. So this is also one of the important indicators to focus on. Then here we have the leverage and insolvency risk. So suppose asset, here you have 10,000, equity is 400. Now here you have the asset loss of 4%. So deposit is the liability for the bank, loan is the asset. So in the asset 4% you have the impairment, right? So maybe NPAs, or you are not able to recover that money. So now your asset will come down 4%, so it is 400 crore. So now you can see that a new equity is how much? It is 0. This is one of the reasons that why we have created extra capital buffer in Basel III, and this is what, which means that whatever you have extra amount that that has been eliminated, and this creates the further trouble, and bank becomes economically insolvent and depositors and creditors face risk, and this further creates the trouble for the banking system. In Basel III, we mentioned about the leverage ratio, but there we talked about the tier 1 capital upon the total exposure, and this is where the difference is. So I have put this slide just for the sake of the comparison. So here we have, if the Basel III requirement leverage is greater than 3%, so it implies that the rule of thumb should be that it should be below 3%, which is good. 3 to 4%, you are in the compliance zone. 4 to 6 and above 6%, it means that you are having you are comfortable and you don't have to worry about. So lower values are considered a major challenge. In India, it varies between 4.5 to 7%, and this is very important. Now, if you think in terms of the overall leverage ratio of Basel III, so these things I think we have discussed already, so we can skip this part. Let's have the comparison, and I'll stop with this slide. So what is the comparison? Comparison is that the leverage that we talked about, right, the total assets upon equity, it talks about the financial structure of the banking. This is what we mentioned. Basel III ratio, which is the total tier 1 capital upon exposure, it talked about the regulatory solvency. So this is where the difference is. Risk sensitivity is another factor which plays important role, and it has the both regulatory and other accounting leverage has more to deal with what you are doing for analysis and any kind of reporting. Basel III leverage is for the regulatory purpose. So with this, I am stopping it here. I hope you have understood the idea behind the distance to default and distance to capital, and I hope you will explore further in those topics and try to understand. I will have further topics in the next session, and we will try to cover some more. With this, I am stopping it here, and thank you so much for your attention. I appreciate it.